In today's world where everything seems to be increasing in price, the need for multiple sources of income is becoming more and more of a need. Just imagine oil prices, commodities, and let's not talk about buying your own property, where the gap between income and owning your own house is getting bigger and bigger. Inflation is eating us up. The salary increase isn't coping with all of it. And let's face it, not everyone is lucky enough to get a high-paying job. So does it mean for the vast majority that fall in the low and middle income bracket don't have a chance to be rich? Will we always be stuck in the rat race and working for the government our whole life, working for the millionaire and billionaires out there? Well, it doesn't have to be that way, because there are ways you can reach that stage of becoming a millionaire or becoming not just a consumer but being an owner as well, even if you don't earn a lot. And one way to do it is to increase your passive income. This is by letting your money work for you. As a famous line of Warren Buffett, if you don't find a way to make money while you sleep, you will work until you die. Now, the vast majority only knows how to trade their time for money, and this is by working and working. But in the case of passive income, even without your presence, you're still earning. Making your money work is the best way to grow your wealth, and the best thing about it, it does not get tired. It won't ever complain about being overworked. So with that, this is where investing in the stock market comes in. The stock market is one, if not the best way to get your money to work for you. But before we dive into that, let's first discuss why people don't use this amazing vehicle. Now, one of the most common mistakes is wasting the potential of your money to grow. A lot of people often just set their money aside in their banks, and worse, some just keep it in their piggy banks, which has the potential to be stolen or lost and doesn't even earn a single interest. And for those who keep it in a saving account that earns so little, their money is being eaten away by inflation, which sits around 4 to 5%, compared to a saving account that earns as little to 0.5%. The interest you earn isn't even halfway near that amount. So why do the vast majority choose this? Because what they go for is security. They choose security over growth. They don't care about the fact that the buying power of their money is getting cut every year. And they also don't like the thought of investing in stocks, because a lot of people, when they hear about stocks, they always put it side by side with gambling. But investing only becomes gambling if you don't know what you're doing and if you're just relying solely on pure speculation. Because if you compare the two, gambling in the casino, you're only in a win or lose situation. My meaning for this, yes, you may win sometimes if you're lucky, but if you lose it all. It's like flipping a coin. You only get two choices, but the chances of winning are rather small. Because as far as your luck goes, the house will always win at the end. That's a proven fact. But in the stock market, it's different. If you lose, you don't lose it all. Although in some cases, yes, some investors lose it all. But it's solely their fault because they went on trading using leverage or debt. Anyway, if you invested properly, you can earn a lot. It's like if I lose, I don't lose it all. But if I win a lot. And that's not all. Even if the stock price drops or stayed the same for a long time, you can still win. To understand this clearly, in stocks, there are two ways you earn money. This is through capital gains and dividends. For capital gains, this is when the stock price increases to a level higher than what you bought it for. For example, if you bought 10 shares of the company for $10, which is a total of $100, then after a few months, if the stock suddenly increases to $15, your initial $100 is now $150. Now for dividends, usually companies that earn consistently pay out a portion of what they earn to their shareholders. This is through the form of dividends. Some companies give out 3% or even as high as 10%. And that's not all. Great companies that grow every year sometimes even increase their payout. So just by holding that stock alone, never selling it, you still earn consistently every year. So going back to our example, if you own 10 shares of that company and the company gives out $0.5 of dividends per share, which is a 5% dividend yield, then for your $100 investment, you get $5 for that year. These are the two ways to earn in stocks. So to what I said earlier, even when the stock price drops, you can still win. This is because while waiting for the stock to go up, by holding that company alone, you still earn through dividends. And if you reinvest all of it, then the compounding force of that will surely pay off in the future, and maybe even offset the loss in capital gains. Now, I'm not just saying this without any evidence. I have experienced this firsthand. I started investing in 2019, just before the market crash caused by the pandemic. From a level of 8,100, the index in the Philippines, which is a PSEI, crashed by more than 40%, and so did my portfolio, which dropped 36%. And up to now, the index is still just halfway from recovering. It is still down by more than 18%. But as for my portfolio, it is already up 9.32%. This is even with half of my holdings still in the negative. This is one example of what I explained earlier. Even though I am at a loss, I am still actually winning the game, and I will just continue this because all the companies I hold, I know are strong because I've researched them myself. I know in the long run they will stay strong and even grow more. Just imagine the power of dividends. In my first year of investing, I only got a small amount, and as the years go by, it has been growing consistently. The dividends I got are now earning more dividends for me. Now, although investing in stocks takes time to do since you have to analyze each company you will be investing in, but fear not, this isn't the only way to invest in the stock market. Actually, even the greatest investor Warren Buffett advises the majority of investors to use this strategy. This is by investing in an index fund. Investing in the index is by far the easiest way to wealth. All you need to do is be disciplined and consistent. Now, I tackled this in one of my videos that even with 1,000 pesos a month, you can still reach the millionaire status just by investing in the index alone. I tracked the index starting from 1987. If you invested consistently every year 12,000 pesos, which is an average monthly saving of 1,000 pesos, in the end, you would have 1.6 million pesos. This is from your total invested money of just 432,000. And remember, this is ending in 2022, wherein the index is still far away from its previous high. Imagine, you've multiplied your money a lot by just investing in one fund consistently. This is an easy way to wealth. No need to research individual companies. No need for the correct timing. That's why index fund investing is known to be the best option and is advised by a lot of successful investors. In fact, index funds had been superior compared to actively managed funds. These funds are the ones handled by expert analysts, and yet they fail to beat an index fund that is just passively following the largest companies in the country. And what is surprising is that active funds charge higher fees. Just look at the Philippines. Managed mutual funds cost around 2% annual fees, but most index funds here charge lower than 1%, and the lowest even charge 0.5% fees every year. And this isn't just in the Philippines, it is the case all around the world. New report finds 80% of active fund managers are falling behind major indices. This is only a 10-year horizon, but remember, this will drop more if we account for fees involved in the long run. That's why if you want to stay ahead in the game, don't complicate things up for you and just choose the proven way of investing, which is an index fund. It's the easiest way and has performed well over a long time horizon. So you have a lot of options in growing your money in the stock market. May it be investing in individual stocks or investing in an index fund, it all comes down to you. If you know you don't have the time to research stocks, just go for an index. Don't force it. If you rely on pure speculation, just because a certain someone is investing in this company and you believe in that person and you think you will become successful doing that, chances are you won't be. That isn't a sustainable strategy. Though the stock market is a proven way to earn a lot, where you can easily tap into the power of compounding interest, you still have to do it the right way. And I've shown in this video that even without knowledge of individual stocks, you can still outperform most investors. And the best thing about stocks, it is a great way to protect yourself against inflation. But again, you have to do it correctly and stay in the market for a long time. Although there are risks involved in stocks, it is better compared to just leaving it lying around your room or in some savings account that earns you little to nothing at all. Now, if you want to know more about a strategy I've shown a while ago, which is dividend investing, I have a video explaining that as well. I'll leave the link below. So ask yourself this, would you rather let your money be rotten away by inflation, or would you start letting your money work for you? It is never too late to start. Though some of us fail to start at an early age, which is the best time to start, the second best time is now. Stop all the excuses you have. No matter how small your salary is, set aside a small amount every month for your future. Do something today that your future self will thank you for. With that, this ends this video for today. Now, if you've learned something, I'd appreciate it if you click the like button before you leave. So thank you and see you in the next video.